A winter morning in Toronto. The familiar coffee shop is still open, but the price of a latte has risen by nearly 20% in just 2 years. Rent is climbing, heating bills are swelling, while wages barely move. Canada, once seen as a symbol of stability and prosperity, is entering a dangerous paradox. The cost of living is rising faster than people's incomes. This is not a matter of perception. Data shows consumer inflation surged after the pandemic, while real wage growth was eroded by high interest rates and hidden costs embedded in prices. The Bank of Canada has repeatedly raised rates to fight inflation, but that decision has turned mortgages, car loans, and credit cards into heavy burdens. The housing market, once a wealth engine, is now a liquidity trap for many households. As global CDS indicators fluctuate, capital becomes more cautious, and open economies like Canada feel the pressure first. The question is no longer whether prices will rise, but why workers in a developed economy are becoming poorer despite working just as hard. The signs of crisis rarely arrive with an explosion. They appear through slow erosion. Nominal incomes rise, but real incomes fall after inflation. Canada's household debt-to-GDP ratio remains among the highest in the G7. While mortgage rates have surged compared to the era of cheap money, personal liquidity is shrinking as families rely on credit cards for basic expenses. Housing prices no longer surge, but they also do not fall fast enough to relieve cost pressure. Small businesses begin cutting hours and delaying hiring as higher capital costs squeeze margins. This is the most dangerous phase of an economic cycle. Macro indicators remain intact, while everyday life is already at the breaking point. Before the Asian financial crisis of 1997 or Greece's debt collapse, early signals looked strikingly similar: rising inflation, higher rates, tightening liquidity, and weakening confidence. Canada is not at the edge, but it is standing on a slippery slope. To understand why living costs outpace wages, one must examine the mechanics of the post-pandemic shock. Global supply chain disruptions pushed production costs higher, forcing companies to pass those costs on to consumers. At the same time, years of loose monetary policy flooded the system with liquidity, making inflation inevitable. When inflation exceeded control, the Bank of Canada reversed course aggressively. Higher rates caused the Canadian dollar to fluctuate with the US dollar cycle, increasing import costs. The labor market appeared strong, but productivity failed to keep pace with nominal wage growth, leaving firms unable to raise pay sustainably. Meanwhile, real estate absorbed a large share of national liquidity. When capital is locked into housing, consumption weakens, creating a cycle of high costs and low growth. This pattern mirrors what many economies experienced before painful adjustments. Global comparisons reveal the underlying structure of the problem. In 1997, the IMF intervened in Asia as economies lost liquidity after excessive foreign borrowing. Argentina repeatedly collapsed under inflation, fiscal imbalance, and currency distrust. Greece paid the price for high debt and weak growth. Turkey and Venezuela represent extreme cases of inflationary failure. Canada does not face these risks at the same scale, but the mechanism is similar. When capital costs rise faster than productivity, households absorb the shock. In those countries, CDS spreads surged before crises erupted, signaling investor fear. Canada's CDS remains stable, yet global monetary tightening narrows the margin of safety. The lesson is not about severity, but about recognizing the path economies follow when living costs outstrip income. The impact on Canada's economy is most visible in housing and domestic consumption. Rising rates push monthly mortgage payments thousands of dollars higher for variable rate borrowers. Many households cut spending elsewhere just to keep their homes. Retail sales slow not because demand disappears, but because disposable income is absorbed by interest payments. The Canadian dollar faces pressure from global currency movements, raising prices on imported goods from food to appliances. Exporters benefit marginally, but those gains rarely translate into higher wages. Liquidity still exists within the financial system, but it is unevenly distributed, widening the perceived gap between wealth and everyday life. An economy can look stable on paper, yet when the middle class erodes, social foundations begin to shift in subtle but profound ways. Government and central bank responses reflect a familiar dilemma. Rates must stay high long enough to anchor inflation expectations and protect monetary credibility. Yet higher rates also suppress growth, slow hiring, and increase recession risk. The government attempts targeted relief through rent assistance, tax credits, and energy subsidies. These measures provide short-term relief but fail to address structural issues like weak productivity and high capital costs. The Bank of Canada closely monitors system liquidity, ready to intervene if financial stress spreads, while knowing that premature easing could reignite inflation. This is a fragile balancing act where every decision carries consequences, and households feel even small policy missteps most acutely. At the household level, rising living costs are no longer abstract economics. A middle-class family in Vancouver must choose between saving for education and covering rising mortgage payments. Young Canadians delay home ownership not due to lack of ambition, but because price-to-income ratios far exceed historical norms. High rates increase latent credit risk, while bank CDS indicators remain under scrutiny. As personal liquidity declines, resilience against job loss or illness weakens. The real danger lies in normalization. People slowly accept lower living standards as the new normal. History from Greece to Argentina shows that when the middle class contracts, social stability and long-term confidence erode as well. Canada is not there yet, but today's decisions will shape whether this pressure is temporary or structural. Survival strategies in a high-cost environment are rooted in risk management, not superficial advice. Liquidity becomes essential. Cash and liquid assets provide flexibility when rates remain high longer than expected. Reducing exposure to variable rate debt is a lesson learned across cycles. Diversifying income streams, even modestly, reduces vulnerability in a slowing labor market. Most importantly, Canadians must reassess the belief that real estate is always a safe path to wealth. Global crises consistently show that those who preserve cash flow and control leverage endure downturns with the least damage. Personal discipline cannot change macro cycles, but it determines whether households collapse or endure. At its core, Canada's challenge extends beyond inflation to long-term productivity stagnation. Without productivity growth, real wages cannot keep pace with rising costs, regardless of headline GDP growth. Investment in technology, infrastructure, and innovation has lagged due to high capital costs and corporate caution. Compared to the US, where productivity rebounded faster, Canada remains overly dependent on real estate and resource sectors that fail to generate sustainable wage growth. Each tightening cycle therefore leaves deeper scars on workers. As global CDS markets price recession risk, capital gravitates toward high-productivity economies, placing further pressure on slower growth countries. Without structural reform, elevated living costs risk becoming a permanent condition.